I'm Brett Quinn, founder and CEO of StrategyX. Businesses have to cover a lot of ground to achieve financial success, and taking a closer look at your financial performance is essential to stay ahead. A three-way financial forecast enables you to gauge the financial health of your business, so you can make better financial decisions in relation to certain scenarios that may or may not eventuate. Let's understand what makes up a three-way financial forecast. A three-way financial forecast combines three crucial financial reports. A P&L, which is a profit and loss statement. It tells you if your business is making a profit or a loss. A cash flow forecast that will tell you how much cash you will have in your bank at the end of each month, and a balance sheet that will give you a clear picture of what assets and liabilities you will have. Let's start with the first component of a three-way forecast, the P&L, the profit and loss statement. The first section of a P&L holds the revenue streams that you will receive from your products and services. For example, if you're selling shoes, you might have a revenue stream in your P&L called shoe sales. It's possible to have multiple revenue streams in this section of your P&L, depending on the number of services or products you have. The next section on a P&L is called COGS, or cost of goods sold. This section shows the direct costs you will incur as a result of being able to generate your revenue. The uniqueness of this cost of goods sold section is that the items you put into this section must have a direct relationship to your ability to generate revenue, meaning that you'll need to buy shoes from a manufacturer before you can sell them to your customer. Another example might be a bakery store. If you're selling pies, you'll need to purchase the filling that goes into those pies, and purchasing that filling is directly related to your ability to sell pies. The final section of a P&L is the expenses section. This is where you'll list all of the expenses required to conduct your business. An example might be the rent or electricity you use in your store. These expenses will go into the expenses section, and expenses are pretty much everything else that's not the cost of goods sold. Allow me to provide one example to help explain the difference between expenses and costs of goods sold. Your shop rent may be one of your expenses, but you could still sell shoes online, meaning that your shop rent does not have a direct relationship to your revenue stream of selling shoes. There are some important reasons why we need to clarify and categorize items as direct costs or expenses differently. These reasons range from how you pay taxes, as some countries have tax laws that tax certain direct costs but not expenses, or how you calculate your gross profit versus your net profit. Whilst we don't have time to go into all the financial metrics today, I would suggest discussing the difference between direct costs and expenses with your accountant to gain a full understanding of how to structure your profit and loss statement. Once you have your revenue streams, costs of goods sold, and expenses listed, a simple calculation then brings your P&L statement to life. You start with the total revenue, then minus the cost of goods sold, and then minus your expenses, and then the answer to this equation will tell you if you're making a profit or loss. Let's move on to how the cash flow statement works in a three-way forecast. Without overcomplicating how a cash flow statement works, think about it like this. A cash flow statement typically has the same sections as your P&L. However, the only difference is the cash flow statement shows when the money is expected to actually come in or go out of your bank account. For example, if you buy stock for your shoe store today, but don't have to pay the supplier of that stock for 60 days, then the cash flow statement will show the money leaving your bank account in 60 days' time. Many people have trouble understanding the difference between a P&L and cash flow statement because they both have similar sections and line items. But just think about it like this. The P&L will record when it is that you actually sell or buy an item. And the cash flow statement shows when the money is actually due to go out or come in, depending on the terms of payment that you've organised with your customers or suppliers. A P&L is designed to tell you if you're making or losing money, and the cash flow statement is designed to tell you when the money is coming or going. If you need a little more incentive to learn about three-way forecasts, think about this. It's actually possible for your business to be making lots of money, but for it to go broke because it can't pay its bills on time. It's simple. You sell your product to your clients and tell them that they have 3 months to pay. So you don't see that cash for 3 months, but your rent and supplier payments are due every month. So it's very easy to run out of money while you still have a profitable business. Having a three-way forecast is like having a crystal ball for how successful you'll be in the future. You'll be able to see the impacts of your financial decisions well into the future and use that visibility to modify your choices today. An example might be deciding to get your shoes from a cheaper manufacturer, meaning that if you choose to sell your shoes at today's sale price, you'll make more profit because the cost of manufacturing the shoes is less. The three-way financial forecasting process is used by companies all over the world. Let's take a look at some of the benefits you'll get from three-way financial forecasting. You'll have enhanced decision-making. Three-way forecasting is generally based on actual and hopefully accurate financial data. Therefore, there is little requirement for too much guesswork. You'll be able to make better decisions because you'll be deriving insights from actual data. Then you can analyze your existing financial strategies and you'll understand what's working and what's not. You'll develop a better understanding of the current market and what you may need to do in the future. It will provide you with valuable insights into your investment to know if it's growing or shrinking. You can also evaluate, of course, your profit, cash flows, assets, liabilities, and equity. Therefore, a three-way forecast provides a very clear picture of all of the financial elements that determine growth and success. You'll be budgeting better. As this process allows you to understand what the future may look like, you can prepare yourself by altering some of your decisions now to set yourself up for a larger profit later. A three-way forecast enables you to decide when you should spend your cash, where you should spend your cash. And from the forecast, you can establish weekly, monthly, and yearly targets that will help your business strategies stay on track. With more visibility over your cash flow, you can either accelerate or slow down projects that have a poor return on investment. You can optimize your profit by looking at income streams and expense sources. With this enhanced level of visibility, and you manage to stay within your budget, you can increase your savings and then invest wisely. You'll also be able to analyze the feasibility of new ventures. For instance, you might plan to invest in a new project. By looking at the forecasting results, you can analyze the potential success of that new project. By predicting the revenues and expenses, you'll understand whether the project meets your business goals. And based on the forecast, you can modify your decisions or even discard the idea altogether. Let's not forget about financial risk. When you can look into the future, you'll make better moves today. With three-way financial forecasting by your side, you can avoid financial risks and setbacks. As you focus on the cash-consuming financial operations, or the sources of loss, you can mitigate those beforehand. Suppose you want to initiate a project. After analysing its revenue and expenses, you find that your cash out will be more than your in. So now might not be the right time to embark on that new idea. In addition, the balance sheet might show that you're increasing your liabilities, inching towards a greater level of debt. So again, you can make the necessary changes to avoid any financial issues in the future. You can evaluate your own overall business model. Three-way financial forecasting enables you to evaluate your business model and its performance over time. It can help you understand if your business will be profitable within a specific time period. And by knowing those details, you can also modify your internal processes, hire new employees, and also take necessary actions. So how can technology help? With dashboards that provide you with the visibility to make great decisions, a risk module to identify, monitor, and manage financial risks, and integrations with your financial accounting software, StrategyX is the perfect business operating system to help you achieve your vision, mission, and goals. In summary, whether you're a seasoned professional or just starting out, you need to keep your finances in check. So, three-way forecasting is one of the most valuable activities you can do for achieving your financial goals. By analysing your cash flow, P&L, and balance sheet, you can take your business to the next level.